Let's get right to today's action with our market panel. Emily Roland of John Hancock and Bob Elliott of Unlimited. Emily, let me come to you first. The VIX, we saw it pretty steady last week and up until today, really, it's now touching nearly 20. Has the resiliency of the first quarter for equities faded?
Yeah, I mean, markets were really ignoring the fact that we've been removing the number of rate cuts that are priced into the markets until this last couple of weeks when they're getting the memo. It looks like we're in a period of higher for longer. The market had done nothing but go up in parabolic fashion, really since the low last October, which coincidentally was when the Fed started talking about cutting interest rates. So what happened was that those remarks, just talking about cutting rates, caused the loosening in financial conditions. Market rallied. They shrugged off this kind of, stalling in terms of the disinflation narrative. But now I think we're starting to contend with the idea that we may be in a holding period before the Fed can actually start to move.
Right. You mentioned the number of rate cuts that investors perceive to be on the table has been declining. Bob, what about geopolitics? How much of a factor here? We've been watching commodities and energy continue to be the outperforming sectors.
Well, I think from a global perspective, what we're seeing is to some extent geopolitics, but I think more broadly, the fact that the U.S. economy and the global economy is not nearly in as bad a shape as many folks had expected. And as a result, what we're seeing is commodity prices push to post-COVID highs, and even their highs of the last 10 or 15 years on a diversified commodity basket. That overall picture is particularly challenging if you're sitting in the seat of a central bank that's trying to shift towards easing, when we see those underlying input price pressures creating an inflationary impulse ahead. And so it's all intersecting between the strength of the global economy, some concerns about the geopolitical landscape flowing through to things like oil, and the need or the concern from global central banks that an easing cycle may be premature.
So there's Fed, there's geopolitics, and Emily, now there's also earnings. We saw that kick off today with some of the major banks. And JP Morgan, down as much as it is, they weren't bad earnings. We're going to get into it in a moment. But what could that be telling us about the rest of earnings season? Has the bar been raised?
Well, of course, it's just day one. Analysts were penciling in 3% earnings growth for the S&P 500, so the bar is pretty low. Regarding the banks today, not terrible, but just pretty uninspiring. The hope was that we'd see positive revisions on net interest income, given the fact that the Fed is likely on hold for longer, but expenses went up because consumers are now demanding higher rates on savings. So we really haven't seen that move higher based on this elevated rates backdrop. Of course, a lot more to come here. 3%, again, a low bar, but that ramps up as the year goes on. And analysts are now penciling in 17% earnings growth for the fourth quarter here. So I think that might be a little bit of a high bar.